Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer and today we're going to be analyzing Yum Brands stock. This one came in by request down in the comment section of one of my other videos. If you have a stock you would like me to analyze, just put it down in the comments. I will get it on the whiteboard behind me and eventually I will make a video. If it's a stock that's in the S&P 500, I post those on YouTube for free. If it's not in S&P 500, I post those on Patreon and in the full Cyclical Investors Club service on Seeking Alpha. If you join Patreon for $5 a month, you can get a big discount if you ever decide to join the full Cyclical Investors Club service, where I have extra strategies that I don't talk about in my public videos and articles, chat room where you can chat with me, direct message me, and a whole group of other investors who are kind of using the same strategies that the Cyclical Investors Club uses. Those links will be down in the description. I'm also going to be using fast graphs in this video. I have a 25% off link, affiliate link down in the bottom. Down in the description. And so if you find this kind of interesting, useful, think you might want to try it. I've been using it about 5 or 6 years now, and it speeds up the initial analysis and kind of big picture things really quickly. So that link's down in the description as well. As usual, this isn't an individual investing advice. This is just how I analyze stocks. So let's get into Yum Brands. Okay, if I recall, the Yum Brands are Pizza Hut, Taco Bell, KFC are the main ones, I think. It's been a long time since I looked at the individual brands. So this was interesting because I actually I wasn't tracking Yum because they had this period where, when I was building out my spreadsheet initially way back in 2019 or 2020, they had this period where earnings growth was really poor, basically. I mean, you look at this period here, basically no earnings growth, and I think they were even like buying back shares. And so there really just wasn't much happening here. And the valuation at this time was ridiculously high at like 30 or something. We're pretty much through most of this time above 20, mostly because of their brand name. People know their brands. Now in I think it was 2017, give or take, they probably around this stock split time, so maybe the end of 2016, they spun off their China brand. So that's Yum C. So if we look, it looks like they started showing earnings in 2017. So sometime around that time, the big Yum company spun off their brands that were in their stores that were in China and the franchises there. And so when I went to look at it again, because of the request that came in, I noticed that recently, earnings growth has been pretty decent. And I thought, well, let's give this another look, and maybe we'll just look at it since 2017 and see kind of how things turn out since then. Well, 2017 was a big rebound year, so I'm actually going to look at 2018 through the expected earnings in 2024 and kind of just see what this trend looks like. Granted, we had kind of COVID in here, but that all seems to kind of balance itself out over these 3 years with a tough year of growth, a big year of growth, and then a kind of back to normal year of growth. So, and then we can see in 2023 things kind of picked back up again. Analysts are looking at, let's see what the PE is. Yeah, it's pretty expensive with the 26 PE ratio. Analysts are looking at 12% growth basically going forward. But I'm going to actually use the historical growth since 2018 to estimate what the earnings growth could be going forward. And I suspect that this is valued the way that it is because of the brands. A lot of this, and they pay a dividend that's been just kind of steadily going up. And I think people know the brands. They feel comfortable. They feel like those brands aren't going anywhere, that those stores are going to do just fine. And so it feels safe and they're willing to pay more money for it. And then because they were doing that even before this, it was a little cheaper back here, but the PE was about the same, this mid 20s. So I think there's just a lot of group of investors that feel comfortable in these kind of well-known brand names that they have known for a long time, and they maybe aren't doing like the actual math that they probably should do in terms of valuation, which is what we're going to do. So let's see what FastGraphs earnings growth. So FastGraphs has a 10.4% earnings growth. That actually includes all this forward forecasting. So I'm willing to forecast okay to 2024, but not any farther than that. When we look at that, it goes down to 10%. So that's what FastGraphs is giving. These guys have bought back about 15% of their stock over this time period since that spinoff. So I like to control for that. I just made my last video that I made, explained how I do that when I'm trying to adjust my earnings growth for that. So what happens when I do it, I'm going to use this period from 2018 to the forecasted earnings of 2024. So that assumes 12% growth coming this year. And when I run the numbers on that, I get 7.5%, so a little more conservative. And then I would also note this is more conservative than the 12% that the market thinks that they're going to grow earnings over the next several years. So this would be my conservative number, and a little later on I'll show what the other numbers might be. This takes into consideration those buybacks as well. I also take into consideration they do have some debt, so the difference between the market cap and the total enterprise value here, I take that percentage and I add it to the stock price to get a more conservative PE ratio and earnings yield. So when I do that, this 23 PE actually becomes more conservative with a 3.26% earnings yield, which is the inverse. Let me see what the actual PE would be here. So this is going to be more, if you include the debt, more like a 30.67 PE ratio. That converts to this 3. So you can see just on the surface, once you adjust for the buybacks, once you are buying the debt, if you were going to buy the company, then the PE looks even more expensive, right? At 30 times. So when we do the math on that, the way I like to think about it is if I bought this whole business for $100, it would pay me back, and I own the business, I could take $3.26 of my $100 each year, and I would get that back, plus that 7.5% earnings growth over time. And I want to see how much money I could accumulate over 10 years if I was just doing that. And I get about $150 on my $100. So you gain an extra 50% over 10 years, basically. If you do the calculation on that, it's about a 4.11% CAGR over the 10-year time period for the earnings and the growing earnings over that time, assuming it's not reinvested or anything. So this is quite low. You can get over 5% with cash. And so, yeah, if I own this, that would probably, and I assume with the assumptions that I'm making, that would probably be a sell for me. But we should also check really quickly. I don't even have a buy price because it's so low. But I mean, probably 50%. It would need to be 50% lower before it would get interesting from where the price trades today. But let's put the analyst 12% in. So this is what the market thinks that they're going to do. When you do that, this gets just into the hold range, a little on the expensive side compared to the average S&P 500 stocks, but definitely in the range that you see. I'm not sure if Yum is in the S&P 500, but I am going to post this one on YouTube no matter what, because it's a big, well-known brand, and it's not going to be like some idea that I'm going to be buying that I don't want, public knowledge of or whatever. So yeah, that's, if you think they're going to do 12%, it's probably valued about the same as the market, but I'm more conservative, and therefore it's just not that attractive to me. I would say the one benefit that you could get from owning a stock like this relative to, treasuries or something would be if we do have persistent inflation of 3 or 4% over the next several years, then they will be more likely to be able to pass that inflation on. In fact, the difference between my 7.5% expectation and the market's 12% might be an embedded kind of 4% inflation, right? Which would almost get you there, including the buybacks. So, so it's definitely almost an inflation call in terms of where to put your money, but I don't see any extra value here in Yum Brands right now. But I probably will track it in the future, just in case it kind of sells off now that we have a little bit clearer picture post spin, and now that it seems like that they are at least kind of growing earnings at a decent rate now again. Okay, hopefully you found that useful. If you did, hit the subscribe button and the like button. And I make videos almost every day now, and the vast majority are requests, and then usually sometimes on a weekend where I have a little extra time, I'll make some videos that get more into investing theory and investing specific techniques and things like that. So, but you can learn a lot by just watching the individual videos, because I try to embed a lot of that into the real analysis that I'm trying to do here. So thanks for watching, and I'll see everybody later. Bye.